So distress has really become a lens into how capital markets are repricing risk. What we're seeing right now, it's not just for sales or broken deals, it's really a breakdown in the capital stack. So in multifamily, for example, the long-term fundamentals are really strong. We're seeing an estimated 4 to 5 million units nationally, and there's barriers to new supply in most markets. And when I mean that shortage of 4 to 5 million units nationally, I mean that's how much housing we think we're short. And so even these great projects in these strong locations are still facing distress because the equity and debt structures no longer work. It's not really about failed assets, but it's a full system-wide reset that's happening, and that's creating opportunity for capital that's willing to step into complexity. And that's really where we focused. Structured investments that can participate in the upside, protect the downside, and bring institutional reliability to situations that demand it. We're not about trying to time cycles. What we're really trying to do is underwrite the misalignment and then use the structure to solve for it. So we're watching the forward curve closely, and in particular the real yields, particularly how the sticky rates stay at the front end, and how quickly financing costs normalize. So the sharp rise in interest rates, it's been one of the big catalysts for the distress today. And so it's made construction loans harder to get, it's pushed exit cap rates wider, and it's really forced a repricing across the whole capital stack. And so when we look at development, that's created a window. So projects that worked under the old rate regime are now undercapitalized or they're on pause. And so sponsors need capital partners who can re-underwrite the deal, bring structure to place, and probably take risk where it's being priced. So we're not waiting on rate cuts. We think the opportunity is here and now, because the high rates have sidelined capital, not because the fundamentals have deteriorated, but just because the structure wasn't necessarily right. So our outlook for the rest of the year is that we do expect continued pressure on borrowers in the back half of the year, as the rate volatility lingers and the liquidity remains sensitive. The bid-ask spread is narrowing, but it's not because buyers are paying more. It's really because sellers are adjusting to the new cost of capital. And so that's going to lead to more recaps, restructurings, and creative capital solutions. So borrowers should really be looking for aligned capital, groups that can have the money, actually transact, they understand where the capital stack is clearing, and who can bring more than just a check, where they can bring value. And so that's the difference in this market. It's really flexibility, certainty, and that ability to navigate complexity that really is more valuable than just the pricing alone.